Hello, everybody. It's time for daily financial update. Today we talk about why the Fed keep rates higher for longer may not be such a bad things. So not need to worry too much. So with the economy humming along and the stock market, despite some recent twists and turns, hanging there pretty well. It's tough case to sell that higher interest rates are having substantially negative impact on the economy. So what if the policymaker just decide to keep the rates where they are for even longer and go through all of 2024 without cutting? It's a question that, despite the current condition, makes Wall Street shudder and Main Street queasy as well. So the rates start climbing higher, there has to be adjustment. And the calculus has changed. So the question is, are we going to have issues if rates remain higher for longer? The higher for longer stance was not what investors were expecting at the beginning of 2024, but it's what they have to deal with now as inflation has proven stickier and than expected, hovering around 3% compared with the Federal Reserve's target of 2%. So recent statements by Fed Chair Jeremy Powell and other policymakers have cemented the notion that the rate cuts aren't coming in the next several months. In fact, there has been a talk about potential for additional hike or two ahead of inflation doesn't ease further. So that leaves the big question over when exactly the monetary policy easing will come, or what essential banks' position to remain on hold will do to both financial markets and the broader economy. The Crosby said some of those answers will come soon as the current earnings season heats up. Corporate officers will provide key details beyond the sales and profits, including impact that interest rates are having on the profit margin and consumer behavior. If there is a sense that companies have to start cutting back costs and leads to labor market trouble, this is a past of potential problem with rates this high. But financial market, despite recent 5.5% sell-off for the S&P 500, have largely held up amid the higher rates landscape. The broad market large cap index is still 6.3% year to date in the face of Fed on hold and 23% above the late October 2023 low. Historically, so history tells differing stories about the consequences of hawkish Fed, both for markets and economy. Higher rates are generally good things so long as they are associated with growth. The last period when that wasn't true was when then the Fed Chair Powell strangled inflation with aggressive hikes that ultimately and purposefully tipped the economy into recession. So there's a little precedent for Fed to cut rates in robust growth periods, such as the present, with gross domestic product expected to accelerate at 2.4% annualized pace in the first quarter of 2024, which would mark the seventh consecutive quarter of growth better than 2%. Preliminary first quarter GDP number are due to be reported Thursday. Okay, this is what a piece of story, very interesting to investor. I see you next time. Thank you.